In September of 2008, something happened that shocked the entire world. One of the largest investment banks in America suddenly collapsed. Not slowly, not gradually, overnight. The bank was called Lehman Brothers. For more than 150 years, it had survived wars, recessions, and financial crises. But in just a few days, it disappeared. Employees walked out of the building carrying boxes. Television cameras captured the moment, and the world realized something terrifying. The global financial system was breaking. Stock markets crashed. Banks stopped trusting each other. Credit froze across the entire economy, and governments began to panic. Because behind the scenes, something much bigger was happening. The entire modern financial system was built on one dangerous idea: debt. Mountains of it, hidden everywhere. Inside banks, inside mortgages, inside financial products that almost nobody understood. And when those debts started collapsing, they triggered the worst financial crisis since the Great Depression. But the real story of 2008 did not begin in 2008. It began years earlier, inside a housing bubble that nobody believed could burst. In the early 2000s, something strange was happening in America. Housing prices were exploding. Homes were becoming more expensive every single year. People believed real estate could only go up. Banks encouraged people to buy houses, even people who could not afford them. These were called subprime mortgages, loans given to borrowers with weak credit, but banks did not care, because they had discovered a new financial trick. Instead of keeping these risky loans, they bundled them together, thousands of mortgages, combined into complex financial products. Then they sold these products to investors around the world. These were called mortgage-backed securities. Investors believed they were safe, rating agencies gave them high ratings, and banks kept creating more loans, more mortgages, more debt. The entire system kept expanding, until the housing market stopped rising. Then something dangerous happened. People began defaulting on their mortgages. Homeowners could not make their payments. House prices started falling. And suddenly, the financial products built on those mortgages began collapsing. The value of those securities evaporated, and the banks that owned them faced catastrophic losses. But nobody knew who was holding the bad debt. So banks stopped trusting each other. Credit markets froze, and the global financial system began to seize. When Lehman Brothers collapsed in September 2008, fear spread instantly across global markets. Investors rushed to sell everything. Stocks crashed. Banks faced bankruptcy. Major financial institutions stood on the edge of collapse. Companies could not borrow money. Businesses stopped hiring. The economy slowed rapidly. It was a financial chain reaction. One bank failing could trigger another, then another. Governments suddenly realized the danger. If the banking system collapsed, the entire economy could collapse with it. So central banks made an extraordinary decision. They stepped in to rescue the system. Governments began injecting massive amounts of money into failing banks. Some institutions were nationalized. Others received emergency bailouts. And the Federal Reserve launched a new policy that would reshape the global financial system. Quantitative easing, massive money creation designed to stabilize markets. Trillions of dollars were injected into the economy. Interest rates were pushed close to zero, and the financial system slowly stabilized. But the crisis left permanent consequences. Debt levels exploded. Central bank power expanded dramatically. And trust in the financial system was permanently shaken. Out of that crisis, a new idea began to emerge. A digital form of money, one that did not rely on banks or governments. In 2009, Bitcoin was born.